Well, Mutual Asset Managers, the company here in London, is just over 100 people, and we'd call ourselves an investment boutique. So we don't attempt to cover every aspect of the investment space, we just concentrate on the things we're good at. We have a very well-known equity desk and equity manager covering UK mid and small cap, a well-known bond team, and myself running the systematic investment team. And as a small company, of course, we have that kind of flexibility. So the three desk heads, very experienced people, are just there to run their products in the way that they think will serve their investors best. Well, as you can see, I'm something of a veteran of these markets. I've been at this well over 25 years. The origin of this strategy really is during my prop desk days back in the 90s. It was a combination of a couple of ideas. I ran a sort of multi-strategy prop desk within the old UBS. And one of the things there was a simple futures cash and carry index arbitrage. Another element was the startings of the trading technology around automated trading. This sort of thing might be quite common now, but in 1997, 1998 is quite unusual. And sort of back in 1998, I hired John because that was his speciality, automated algorithmic trading system.
I think firstly, my own background and Paul's background is very much in the proprietary trading field within major sell-side banks. So what we've essentially done with the statistical arbitrage strategy here is to take what we would describe as a market-making operation and turn that into a systematic trading strategy, if you like. So we're taking something that you would typically do on a proprietary basis in a bank and turning that into a fund. So that differentiates us, I think, very much from the pack in terms of stat arb.
Well, what we're looking at is the way that equity prices evolve in the short term. So the actions of markets actually push prices apart. Think about it, all an equity market is a place where buyers and sellers come together. But what do they really want? They want somebody to take the other side of the trade. Every buyer needs a seller needs a buyer. Their actions actually push the prices of equities slightly apart. If there's a big buyer of a stock, the stock will rise. We will sell them a bit, it will rise a bit more, we'll sell them a bit more, and so on. So there's a very small class of people, ourselves, and maybe in the old days the market making desk, will provide liquidity into that. If you come as a bid buyer to a market, you want to buy a big line of stock. No one has that stock, we short it to you, we create the demand and fill the order that way. So those natural actions just push prices apart from their equilibrium. We supply on the sell side, we buy stock on the buy side. Once that pressure is over, the prices normalise, we cover the positions, we make a turn doing that. So what we're really talking about is adding liquidity to the markets. You're being the liquidity provider. And economic theory says that if you provide liquidity to markets, you should be paid for it. What we've seen is that the correlations of many hedge fund returns, particularly the very large funds, have tended to grow. So investors really need to look at some of the smaller and more specialist spaces to get the kind of performance and diversification they really want. So statistical arbitrage, and particularly this individual strategy, has three main advantages. Firstly, it simply works. It does produce compound returns through a cycle. 2008, 2011, it produced positive numbers. Secondly, the lack of correlation. It really is zero correlation, not just with equity markets or bond markets, but even with other hedge fund strategies. And as we discussed earlier, that's because the performance drivers are really quite unique. And thirdly, it has positive skew. Very unusually, the right tail is bigger than the left. We tend to outperform in dramatically difficult markets. A very unusual feature and very hard to find. This is a real market neutral strategy. It is market neutral, it is sector neutral, we take no direct currency exposure. We were able to fit it quite easily into a UCITS format. It turns out because the fund itself, the strategy, is relatively low leverage, the instruments are quite straightforward, they're equities and CFDs, and because the gearing is relatively low anyway, we were able to fit this into a UCITS wrapper without changing the strategy in any way. And I think that's important because it means that the UCITS vehicle will track the underlying fund very nearly perfectly. We have a lot of experience of this with the Lyxor hedge fund and now with the Lyxor UCITS format. One of the issues, as you know, with UCITS is the tracking error between the UCITS and the underlying. But given our experience and given the nature of this strategy, we really don't expect any tracking error at all.